Hello, everyone. This is Kathy Lien. If you can see my screen, hear my voice, good morning, everyone. Welcome to Kathy's Caffeinated Market Buzz, where every Monday we talk about all of the big events that could be affecting the markets this coming week. Now, I need you to do me a favor and let me know that you can see my screen, see my charts, and see me and hear my voice, that everything is working okay. And I'm going to take a quick peek. Good morning, Miguel. And for those of you that are coming over YouTube live stream, let me know that you can, let me know where you're from. Let me know that you can hear everything okay. Sounds like everything's sounding good. Mark, John, Steve, Ricardo, Godfrey, Andrew, good morning, everyone. There's a lot to talk about today, and I'm excited to have all of you with me because we do have, hello, Cheryl. We do have another data heavy week ahead of us. Good evening, Yanni from Thailand. I always love speaking to everyone on Monday because it really gives us an opportunity to set up for the coming week. And I love, seeing everyone from all corners of the world. Now, last week was a very, very interesting week. But first, let me just confirm to me that you're seeing my fundamental heat map. Everything's looking good, right? Okay, thank you so much, Leo. Okay, so as I said, last week we had a huge Monday, and thankfully this Monday is much calmer. We're not starting off with 1,000-point drop in Dow futures and what was it, 12% drop in the Nikkei. So I think everyone's happy that we have, quieter start to what should be a busy trading week. And normally I would say this would be a very, very busy trading week because of the importance of the data on the calendar. We have US, the most important piece of data is going to be US inflation data, US retail sales data, but that's not it. We also have a lot of other key market moving reports on the calendar. We have the Reserve Bank of New Zealand rate decision, we have Australian jobs, we have GDP reports from Japan as well as the Eurozone. And we just have a lot of event risk on the calendar, which normally, given a standard week, should lead to quite a bit of volatility because the market is still very, very much divided on what happens next for a lot of these countries. We'll talk about each one of these in particular and what is expected and look at the Fed chart on what's priced in for rate cuts and what this week's economic reports will mean. But first, I think it's important to just take a step back and talk about how last week we had a significant carry trade unwind on Monday. But then what happened? What happened after Monday? It was pretty much a week of recovery on Tuesday, Wednesday, Thursday, and Friday, against all expectations of fear of an aggressive continued decline. We did not get that. And some of that could be due to the comments that the Bank of Japan made and suggested that that they are not necessarily going to raise interest rates again quickly. Some of that could be attributed to the positive effects of a more aggressive interest rate cut by the Federal Reserve. But regardless, and also some of that, there's been a lot of talk about people saying that maybe the carry trade is not as big as previously in previous years. That maybe a lot of the money wasn't necessarily put into yen, into short yen trades and long risk trades, and that a lot of foreign investors, instead of putting money into actual carry trades, actually put their money into buying companies. Like there's a lot of investments you may have heard in the past couple of decades, or not decades, past couple of years, by Warren Buffett into Japanese brokers, and that's not something that's very liquid, right? When the markets crash, they can't just move their, it's not, he can't just move his money in and out of his investments in Japanese brokers. And so there's a belief out there, and no one can really figure out what the size of the carry trade is, but there's a belief out there that the carry trade size is not that large, and therefore the carry trade unwind, or the liquid version of the carry trade, is not that large, and therefore the carry trade unwind wasn't going to have much more continuation. So there's a lot of arguments for why we did not necessarily get the continuation that you would think after such a bloodbath last Monday. So now we're walking into this new trading week, and everyone's thinking, could this week's economic reports tip the scale and renew the sell-off in the US dollar and renew the sell-off in stocks? Now, I do want to say that the sell-off in the US dollar is a very different dynamic story than the sell-off in US stocks. For example, if we do have weaker data that is negative for the US dollar, but a growing likelihood of the Federal Reserve lowering interest rates and lowering interest rates aggressively is not negative for stocks necessarily, particularly if it's due to weaker inflation. Because if you think about it, we all want weaker inflation. We all want inflationary pressures to be slowing, meaning that prices are not being raised as quickly as they would want. So weaker inflation, that could actually be good for stocks. So just because it's not like last week where it's non-farm payrolls being weak is unambiguously negative for the dollar and stocks. In this case, if it's driven by inflation, it may not be so negative for both. And that's the point that I am trying to get at. That's the point that I'm trying to say, is that it may not be so negative for both. And that's what that's important to pay attention to, because stock futures are up this morning and the dollar is up. But the question is whether or not this is durable. So let's talk about that. Starting off with the dollar, this is my heat map that you're looking at. And this heat map is available for all BK traders, and I update it every week. And so I am bearish dollars. I am bearish dollars because I believe that this week's economic reports are going to be softer. I think this week's economic reports are going to be weaker. And, it's just kind of weakness compounded upon weakness compounded upon weakness, because we had the abysmal non-farm payrolls report, which was weaker on all fronts. And then we kick off the week with the inflation report. And with the inflation report, one of the most important, when we look at inflation, we look at what goes into inflation and what drives the CPI index. One of the most important things is going to be oil prices. And I just want to, you to look at this. Ignore my moving averages. But in the month of July, this is oil prices. In the month of July, I'm going to pop my arrows onto here. You can see we started July right here in oil. We ended July right here in oil. So look at what oil did. Oil basically tumbled in the month of July, erasing all of June's gains. So oil is is what the headline number makes. I know that everyone focuses on ex-food and energy, which is important. It's very important, but you can't ignore that oil affects how much people are taking out of their pocketbooks, and it does affect inflationary pressures around the world. So clearly, oil prices have dropped pretty much in a one-way decline in the month of July. So from an oil perspective and from a CPI, how oil contributes to CPI, on a headline basis, CPI should be weaker. So, it's not rocket science, because, Fed officials are already saying that inflationary pressures are kind of moving in the right direction. So inflationary pressures are expected to be weaker. And then there's consumer spending. And with consumer spending, all of these retailers have already warned about how consumer spending could be weaker and how, they're having troubles with earnings. So the two most important pieces of data this week, inflation and consumer spending, are expected to be weaker. But the next question to ask is, how much does it matter, right? Because what's priced in? So let's look at CME Fed Fund futures. And very, very simple, Google CME Fed Fund futures, and I'm going to accept all cookies. So CME Fed Fund futures. So there are 3 more meetings till the end of the year: September, November, and December. So there are 3 more meetings for the Federal Reserve until the end of the year. So let's talk about what's priced in. Okay, so right now we're at 5.25%, 5.5% rates. So if you take a look at this, you can see that the market is basically pricing in a 100% chance of at least a move from a 5.25%, 5.5% rate to 5 to 5.25%. So that would basically be a 25 base. Well, it's more. The market's pricing in 50 basis points of easing, because at this point they're actually looking at 4.75% and 5%. So the market is pricing in a 0% chance of rates remaining unchanged, a 50% chance in September that we're going to get a 1/4 point cut, and a 50% chance that it's going to be a 75 basis point cut in September. And by December, the market expects, we're currently, look here, 5.25% and 5%, 5.5%. The market is pricing in at least about, what is this? Almost 100 basis points of easing, which has been very, very aggressive. So if you think about this, the market has priced in at least 1 interest rate cut next at the end of next month. And there's talk that there could be, and the market believes that there could be 2 interest rate cuts. So as we look at these incoming pieces of data, the question is, how do these incoming pieces of data affect the expectations? Does it build the case? Has the market priced it in? And while it can be argued that the market has priced in 1 full interest rate cut, I don't think that they've necessarily, at least looking at these Fed fund futures, because they did change. Because if you look at this 1 week ago. I don't know if you can see the very bottom. 1 week ago, here, 1 week ago, I'm going to highlight it. The market was pricing in 85% chance of 2 rate cuts in September. 85% chance of a 50 basis point rate cut. Now that has dropped to 48.5% chance of 50 basis points. So the odds have changed. And that's why I think maybe a week ago, a weaker inflation report, a weaker retail sales report may not have had as much of an impact as this week, because the odds of a rate cut have fallen so much. So keep an eye on this. I don't think they've really fallen in the people's minds as dramatically as these numbers show, but they're still going to have an impact, because the Federal Reserve is not saying the same thing as what the numbers show. The Federal Reserve has not admitted that 50 basis points is necessary. Instead, they've actually kind of downplayed the need for any type of emergency rate cut. They've downplayed the need for an overly aggressive interest rate cut. So I don't think that their minds are in the same place. The Federal Reserve minds are not in the same place as what these Fed fund futures show. And that is very, very important to pay attention to. So that's important. And then also, if we take a look at what is expected in November, you can see that in November, the market is fully pricing in a 50 basis point cut. So the question is, will the Federal Reserve push this to kind of divvy it up between September and November? And the November meeting is quite interesting, because the November meeting is actually right after the election. So this is kind of important, because everyone talks about whether will the Federal Reserve, should the Federal Reserve, or maybe not everyone, Trump specifically is saying the Federal Reserve should not be making interest rate changes ahead of the election. So the US election is on the 5th, I believe. And the Federal Reserve meeting, the November meeting, is on the 7th. So that meeting is after the US election. So maybe from a politically neutral perspective, it would be fairer for Powell to split up that rate cut from half in September, maybe 25 basis points in September and 25 basis points in November. Please comment in the YouTube chat whether you think that politically that Powell gives a crap about, you know, whether the rate cut will impact who wins. I want to hear your thoughts on that for sure. But perhaps, you know, on a political perspective, splitting it up would not help the chances of one candidate versus the other. Whether or not he cares, whether or not it happens is a different story. But behind the scenes, that could be a motivation to not do 50 in September and split it up between September and November. 25 in September, 25 in November, and then maybe 25, 50 in December, depending upon how things go. That's a possibility. Also, you know, they don't seem to necessarily be bought in the story. And also spreading out interest rate cuts, you know, is generally better when the economy is not in so much shock or a recessionary condition to warrant such a large interest rate cut. So there are many arguments for why they could only do 25 basis points in September. But it's hard to say. And that's why each piece of economic data, and we do have 2 inflation reports before the September meeting, and one more non-farm payrolls report. So that's why each piece of these economic reports could still have a significant impact on the dollar. Now, also, but I do want to say one thing, which is that this is we're in the deep of summer, the August doldrums, and because we are in the depth of summer, that is very, very important because it is something, you know, because that could reduce participation. And when it reduces participation, that also means that it could reduce exaggerated moves in the market. Some of you are asking, is tomorrow's PPI report, you know, is it important because it's going to give us a clue into CPI? It's absolutely important. That's a very, very good question. It is very, very important because when we have usually PPI is not important when it's after CPI, and there are plenty of months where we do get it after the CPI report. So we do get it after CPI report, and it's far less significant when that happens. But there are also periods of time where we get it before the CPI report, and this is one of those months. So yes, PPI doesn't always have, you know, as clear of a line of an impact to CPI, but I think it's still important. And I do believe that PPI is going to give us a guide to CPI, and but it's not going to be as important as the CPI report itself, and that should be obvious. Okay, so now let's move on and talk about the euro. So we're talking about the dollar. We'll look at some charts. We'll go into the economic calendars in just a second. But let's talk about the euro. So this week, so basically last week we had euro recovery, right? I mean, the euro is trading and holding 109, and Eurozone data has been mixed. We know that Germany is in a tough spot, and Germany seems to be the weakest part of the whole region. And whereas the rest of the region, like France and Spain and Italy, seem to be doing better. So this week we have 2 things to watch for the Eurozone. The first thing is going to be the German ZOO survey. And so the German ZOO survey, you know, that's a measure of how analysts feel. And analysts generally, you know, after the meltdown that we had last Monday, and you know, just kind of the uncertainty in the markets, are probably going to be a bit more nervous, I think, about what's happening, particularly in Germany, than the rest of than like a month ago. So I think the ZOO survey is actually going to be weaker. The GDP numbers the GDP numbers are going to be released, but this is the second release of GDP. It's not the advanced release. So we care a lot less about the second release than the advanced release. I don't think that's going to matter at all. The reason why I'm neutral euros and neutral a lot of these is because let's not kid ourselves, all right? There's only one thing. There's only two things moving the markets this week. Number one is going to be US data, and number two is going to be risk appetite, none of which is going to be driven by Eurozone data or what happens in Europe. So Euro is going to really just take its cue from the market's appetite for US dollars, as well as for the risk appetite in general. And the reason why Euro's back up above 109 is because risk appetite recovered at the end of last week and is also positive right now. But this is a huge week for the UK. And now it does come after the Bank of England rate decision. So it's not like it comes right before the BOE rate decision, which makes it more important. It's coming right after the BOE rate decision. So it's slightly less important, but still very, very important. We have UK inflation, employment, retail sales numbers, some very, very important reports from the UK. And if you remember, and also we have UK GDP numbers. If you remember, the last time the UK, the Bank of England met, they basically left interest rates, they lowered interest rates at a 5-4 margin. So it was a really, really close call. And the economist, the chief economist in the UK did not vote for it and does not believe that further rate cuts are necessary immediately. So it will be, and a lot of that could be due to this week's data, because I've been looking at the PMIs, and if you've been coming to my Monday Market Buzz, I talk about how much information the PMIs provide, and the PMIs and the ISMs are so important because they are the first release, the most recent release that you get for how a country is doing. So it's kind of the guide for the reports that come out for the rest of the month. And so the UK PMIs have actually been pretty good. And from a labor market perspective, you would think that everyone is not hiring. But according to the PMI reports, manufacturing and service sector activity has been improving enough that firms in both sectors are hiring. And so, that could lead to stronger labor market numbers tomorrow. They are being released, pretty much tomorrow. And then both manufacturing and services also reported higher price pressures, higher inflationary pressures. So that is also something that is important. And if we get higher CPI, that could definitely accelerate the gains in sterling. And then in terms of the GDP numbers, the GDP numbers won't be that great because we did have in the second quarter, we're in the third quarter right now. In the second quarter, we did have weaker retail sales and trade activity. And then on retail sales front, that's on Friday. That's a little bit of wishy-washy. So we expect stronger UK data in the front of the week. The end of the week is hard to tell because we had slightly higher BRC retail sales monitor, but the CBI index was a little lower. Okay, so now on to Aussie. Aussie is one of the strongest performing currencies this morning. And a lot of that is due to the RBA being one of the most hawkish central banks. And over the weekend or overnight, we had one of the RBA officials come out and basically said that, inflation is sticky and, make all these comments to confirm that they have no plans to lower interest rates anytime soon. This week, we have Australian labor market numbers, and those numbers, jobs numbers are always important, right? And I might as well show you. This is the spreadsheet that I create for BK members. Let me see if I can snap this. Oops, that is not okay. Here we go. And it goes over, kind of my expectations. So with the Aussie jobs report, it talks about how the UK employment numbers were stronger. Because the PMIs were stronger. Talks about the PPI, CPI that we just talked about. But with the Australian jobs report, we had stronger manufacturing PMI, weaker services, but we had really, really robust job growth in June, 50,000 jobs, 43,000 of which were full-time. So I don't think it's going to match that. I think it's going to end up being weaker. And so I think there is some downside surprise. But even though there could be some downside surprise on that front, I think that, that Aussie, first of all, don't kid yourself, Aussie's going to trade on risk appetite. But I think Aussie could still outperform its peers. But be careful of that jobs report. Last week was a huge week for Canada. This is not a week for Canada at all. We have really nothing of any consequence in Canada. So Loonie will trade on oil, it will trade on risk appetite, it will trade on dollar flows. And Canadian data has been kind of mixed. There's a belief that it could sell off further if we do get any sort of dollar recovery. The New Zealand dollar, on the other hand, is going to be in play. We have the Reserve Bank of New Zealand rate decision. And lately, New Zealand data, except for last week's employment report, really hasn't been that great. So the market is actually pricing in a 25 basis point rate cut by the RBNZ. But the shadow RBNZ, who basically predicts, a bunch of experts and economists in New Zealand predict what their own central bank will be doing. And I think, there's a lot of merit to that because these are local economists. And these local economists basically feel that they don't need to lower interest rates right now. And that maybe it'll be later this year that they do this. And so, this means that the RBNZ rate decision is going to be a really close call and a big market mover. Will the RBNZ deliver their first interest rate cut this year? Taking a look at the Kiwi chart, and Kiwi is single-handedly it's the strongest currency this morning. Kiwi is the strongest currency this morning, up 0.42%. That tells you that the market doesn't think that the RBNZ is going to lower interest rates. I say it doesn't matter. Even if they don't lower interest rates this week, they're going to signal probably that they will lower interest rates at the next meeting because, both the experts as well as the market is pricing in at least one interest rate cut by the RBNZ this month or next month. So they're going to cut, and that's going to make Kiwi bearish because a bunch of people will be surprised, or they'll hold and they'll say they're cut soon or signal it, and that will end up being Kiwi bearish as well. So that's why I'm Kiwi bearish. Neutral Swiss francs, that's going to just be, there's no major Swiss data this week. Swiss data has been mostly weaker, but I think it's going to trade on risk flows. The yen is lower across the board this morning, partly because Japanese markets are closed. And I still think the yen is going to rally. I still think risk off sentiment has not evaporated. I think that investors, once you get investors nervous, they are not going to change, suddenly be optimistic again for no apparent reason. So I still think that the yen could end up rallying this week, even though the yen is lower across the board this morning. So we're going to look at the eco calendar, but before we do that, I just want to talk about the links I have here. Apex is still running for just that ends this week. They're 80% off sale, although they seem to always extend it, but you never know. They're still running their 80% off sale. So I've included a link in the YouTube live stream. You can click on that. Also, if you want to become a BK member and get access to the heat map, to the calendar, to my trade ideas, we made, I think 300 pips last week. You can click that link for the big discount. And then if you want to learn how to trade with fundamentals, definitely check out my fundamental course. And I will get to all your questions later on after we get through the calendar. Also, for those of you that are American, I want to share with you the Gelber Group. The Gelber Group is is a very old prop firm here in the U.S. and they've been around for a very, very long time. It's my internet connection that's loading slowly here, but they have a contest called the Breakout Contest for U.S. traders, where anyone in the U.S. can participate for up to $35,000 in cash prizes and a potential to get a job, either remotely or in person in New York and Chicago for, a real legitimate prop firm that has been around. Gelber has been featured in Market Wizards, so, he's been in the industry for a very long time. click on official rules for all the details there. It's a really cool opportunity that begins in September. So if you're a US trader, it's completely free. Don't miss out on this. All right. So going into the economic calendar, we had nothing released yesterday. Basically, RBA speech, nothing there. And then, they've really littered the calendar with ads. I think we might go to Forex Factory because there's just way too much going on here. Okay, this is a much cleaner economic calendar. So today, we had building permits from Canada. It came in weaker. It wasn't a huge market mover. Tonight, we have visitor arrivals from New Zealand, also not a big market mover. Australian Westpac consumer confidence. That's going to be interesting for future things like retail sales, but not really a huge market mover right now. Same thing with NAB business confidence. That's going to be very important later on. And I think these numbers will be important. Maybe Aussie could be, on the move a bit tonight. Tomorrow, we have the UK jobs numbers. And as I said, the UK PMI shows stronger job growth in manufacturing and service sectors. So I think that these numbers could be better. The German ZOO survey, on the other hand, will probably end up being a little weaker because think about it. ZOO measures analyst sentiment. And after the crash on Monday, I don't think that they're going to be really all that optimistic. Then we have the PPI numbers some of you asked about. And yes, the PPI numbers are a leading indicator to the CPI numbers. Market is expecting softer PPI. And if we get a reinforcement, particularly in the headline number of softer PPI, that could take some of the steam out of the dollar rally. And then tomorrow night, we also have the Reserve Bank of New Zealand rate decision. As you can see, market is not expecting a rate cut, economists are not expecting a rate cut, but the market expects a rate cut. So someone is going to be surprised. I think they're saying that there's the market's pricing in a 70% chance of a rate cut by the RBNZ. So someone is going to be surprised. And I think that that's going to make for very big moves in Kiwi that night. And then on Wednesday, the inflation data from the UK. And you can see here that the market is expecting softer, mixed. Softer PPI, but stronger headline CPI year over year and weaker core CPI. Bottom line, as I showed you on my own calendar, the PMIs show stronger inflationary pressures. So this could surprise the upside, which could actually be positive for pounds. We have the GDP numbers from the Eurozone, which is expected to be weaker, led by Germany. But the main event this day will certainly be CPI from the US. And I will be live trading CPI on Wednesday over YouTube. So make sure 8:15, we're going to be live trading CPI. Make sure you click on that link and join me at 8:15 New York time. We're going to be live trading CPI then. And then we have, and then as I said, the market actually here, economists think CPI is going to increase, but I think CPI is going to surprise to the downside. We have RBNZ Governor Orr speaking. That's going to be important. We have Japanese GDP numbers, and that should definitely be stronger because Q1 was a period of weakness. Q2 was a period of recovery for Japan. So that should help the Japanese yen. We also have Australian jobs reports, and weaker job growth is expected because it'll be hard to beat last month's stronger job growth. We have a bunch of data on Wednesday from China, retail sales, industrial production, the labor market numbers, and I think most of these are going to be weaker. And then on Thursday, we have UK GDP numbers, and UK GDP numbers are expected to be a little softer. We have US retail sales numbers, and that's also very important because, consumer spending is the backbone of the US economy. And, you can see the market's looking for stronger consumer spending on a headline basis, mostly due to auto sales. If you strip out the auto sales component, core retail sales are expected to grow much slower, 0.1%. versus 0.4%. So if you have weaker inflation, weaker retail sales, that could be really bad for the dollar. We also have Philly Fed and Empire State that day, industrial production. So a big day. Tuesday and Wednesday are big days. Wednesday and Thursday are big days for the dollar. And then New Zealand inflation data, that's going to be important, but takes a back seat after the RBNZ rate decision. More speeches from down under. And then on Friday, we have UK retail sales numbers, a bit of a rebound expected. We also have some minor data from Canada, not worth talking about. We have building permits, housing starts in the US, and then the University of Michigan Consumer Sentiment Index, which I can't imagine that would be stronger, because we did have the crash in the markets. We had weaker labor market conditions. I can't imagine that we're going to get stronger US sentiment numbers. So let's go ahead and take a look at the charts. And before we take a look at the charts, I want to remind you that I will be live trading US CPI on Wednesday starting at 8:15. All you do is go to YouTube, same way you came here, BK Forex, /BK Forex, and go into the live tab, and you will get that video. And please, I encourage you to watch this US election video I just put up. It's got a lot of really good content there on how the US election could affect gold. So make sure you look at that as well. So taking a look at the charts, Euro, is everything is pretty much, today's a day of consolidation, aside from maybe the yen crosses, which are up nicely. Euro's just consolidating in a tight range. The range is narrowing, so clearly, a breakout definitely feels like it's imminent for Eurodollar. No surprise as to what could cause a breakout. That's certainly going to be probably the US inflation report. And I think the break could be to the upside. If we get to break to the upside, 110 is going to be resistance in the Eurodollar. And although if we get to break to the downside, there's a lot of support of 108.50. But Euro is primed for breakouts, all consolidation ahead of Wednesday's inflation report. And that's, we have the zoo tomorrow. That could be a little weaker, so we could test the bottom of this range, but I think the real move will come after that. Sterling is already rebounding after a really big pullback that we had in the currency. And so I think that I'm just gonna pop on, a near-term fib here to show you that it's absolutely, fibs matter. There's no coincidence that the move pretty much stopped right at the 50% fib of that move that it drew. So we're above that right now, and we only have the 50 SMA above us. So if we get a move above this 50 SMA, which is at 127.86, I think it will squeeze to the next fib level at 128.70. And I think, taking a look at the fundamentals, there's more reason to believe there'll be stronger sterling data than weaker. Dollar yen's turning positive. We're not getting major US data until Wednesday. This recovery could continue. I think we could get up to 150 for no reason other than flow. Now, there is a little bit of resistance between now and then, because if you remember when we drew our fibs last week, let's get rid of these moving averages. When we drew our fibs last week, we said that there, or 2 weeks ago too, we were looking at where the decline could stop. And so, we have, one, I guess we're already above that one. So we're gonna have to take it from the longer term fib. I don't keep the fibs on my chart, so that's why. So yeah, we were looking at where it could stop, and it's no coincidence that that move stopped right at these key fib levels. So now let's take a look at the near-term fib of this move here. So where could this move stop? So how much could we rally? Let me just get rid of this here. So dollar yen, the next key level, while we would think psychologically it should be 150, dollar yen, unlike euro, pound dollar, which loves to run for the round numbers, oftentimes will stop before the round numbers. So the next resistance level in dollar yen is at 149.50, the 38.2% fib of this move. I think it could get there before the US inflation report, and then it will be all up to CPI. Dollar Swiss, with dollar Swiss, we have, also the similar kind of meltdown that we had in dollar yen. Resistance is probably going to be right at this breakdown point here. 87.78, which is not far from the 20 SMA right here, 87.70. That's where I think the resistance level in dollar Swiss is. If it can test there, if it rejects it, then it's probably coming back to the zone here at 86.50. Aussie dollar, lots of resistance right here. We do need to close above the 100 SMA for upside traction. And with so much major event risk coming up, I'm not sure it will readily do that. But we do that, there's going to be a lot of resistance at 66.50. If we fail here, it's probably headed back down to 65 cents. Kiwi dollar, also really nice recovery, but falling short of a lot of resistance at the right between 60.40 and 60.50. So I don't think, we've got RBNZ coming right up. I don't think we're going to really break beyond that and have any meaningful moves until afterwards. I think it's going to happen after RBNZ. Dollar CAD crashing lower, finding support right at the 50 SMA. I think there's a very good chance that it's going to hold this 50 SMA. It's already done it 4 times in a row. I think there's a stronger chance it's going to hold than it's going to break the 50 SMA. Okay, so now, let's look at gold as well before I go to questions. Feel free to type in your questions. Gold, really nice rally. You've got to watch this election video I have on gold. I talk about how a Trump versus Harris win could affect gold's prices. But back to the chart in gold. Gold's rallying. Gold looks like it wants to test these levels here at 24.80. And I think it could. This is a very strong candle. We have the 5 trying to cross above the 20 SMA. So I do think that gold should move higher. All right, let's see your questions that you have. And in the meantime, while you're kind of looking at those questions, once again, my US traders, please check out the Gelber Group's $35,000 in cash prizes contest for, if you think you think you're a good trader, participate in the contest. There's no cost to you. It's a 2-month-long contest. And then, you could win up to $35,000 in cash prizes. I think it's like $20,000 for first place, $10,000 for second place, $5,000 for third place, and a potential job at the Gelber Group. And also training, mentorship by, veterans who have more than, who had 7-figure P&Ls basically. All right, so going back to the charts and your questions, let's see what kind of questions you have. What about pound yen? Sure, let's look at pound yen. And also, I have a different view of the reason the stop in euro yen, dollar yen, is that both of them retraced around the fibs. Yes, technicals could be impacting why the yen pair stopped. We saw a technical level in dollar yen, but such a big move can't just be driven by technicals. It's technicals and fundamentals, and maybe there were some buy orders at the bottom levels off of the fib retracements. I think that's certainly the case. Pound yen rallying on bullish pounds. I think that, and there's no major US data till Wednesday. I think this pound yen rally should continue in the near term up to 190, almost 191, which I think is a good pivot from here to there. So that's, I think there's definitely could be a further recovery in pound yen. Another reason that traders are waiting for September in order to get a better clue of the Fed rate cut, yeah, I mean, we need more than one. I mean, we're going to have a lot more data between now and then. And where can I find upcoming geopolitical news? I mean, schedule for the upcoming week before Putin happens, like Putin visiting North Korea. There's no calendar for that. You just have to follow, the news flow. And if you read forexlive.com, they always talk about the big events that are coming up for the week. Can I analyze what's happening to silver? Sure. I don't trade silver. I'll just tell you that, but we can certainly look at it. So silver, is underperforming. It's not trading the same way as gold. Gold is definitely soaring. Silver, on the other hand, is suffering. And silver, it's good that silver has kind of bounced off of this consolidation area at 26.50. I also think it's going to head up a little bit more to 28.50, but probably not much more beyond that. And then what is my expectation for US CPI? So once again, I'm going to be live trading CPI on Wednesday starting at 8:15, so make sure you join me. And then as for CPI, I think it's going to be weaker. We looked at oil prices, how oil prices basically plunged in the month of July. It's my two arrows show the beginning of the month, the end of the month. Oil prices plunged in the month of July, and so I think that's going to put quite a bit of pressure on inflation. Euro Kiwi, sure, I can look at Euro Kiwi. So Euro Kiwi is down today because Kiwi is one of the strongest performing currencies. But there's a lot of uncertainty, right? The market as well as economists are completely divided on whether the Reserve Bank of New Zealand is going to lower interest rates. I would not touch Kiwi until after the RBNZ rate decision, because this outlook could completely change. It looks like we have a descending triangle. It looks like Euro Kiwi wants to break down, but if they cut, then we should see Kiwi sell off and Euro Kiwi rally. If they do not cut and they're dovish, that still could be positive for Euro Kiwi. So I wouldn't touch this until after the RBNZ. I think I'll have some really clear, really good moves after the RBNZ rate decision. Can I ask why NFP data caused NASDAQ to rally, but gold rallied to the upside? Well, the NFP data, I think it's just the market thinks that it's going to, so it's what I basically said at the start of our conversation. How a piece of data impacts, a piece of data could very well impact the dollar and stocks differently. Because if the market thinks that this is a weak number that's going to lead to a aggressive interest rate cut, that is actually positive for stocks, right? But negative for the dollar. I mean, ultimately, it's not good for the economy. Thank you, Kathy. I love your videos. Great explanation. Do you provide updates once I buy the fundamentals course? It's just a course. This teaches you how to use fundamentals to trade and how to look at how different markets impact each other like I do regularly. In my 3 books, which one do you mostly recommend? Absolutely, day trading and swing trading. The currency market is the most detailed. It's the one I poured my heart into. The other ones are for beginners, which are really good for beginners, but there's a lot of kind of very basic information in there. Whereas the day trading and swing trading, the currency market, people are highlighting it. They go back to it. I'm very proud of it. If you're going to get one book, that's the one you should get. Is volume typically lower until Labor Day? Yes, but lower volatility could also compound. Lower volume could also compound volatility. So that is important. The Gallagher Group contest is completely free. They're not trying to sell you anything. They're trying to look for traders. They believe what I believe, which is that retail traders could be as good as their pro traders. And so they want to find those to basically fund and trade for them. They're taking baby steps into this space and trying to see if they could find some good traders in the space, and which is why it's only US, because they're an American firm. And but even if you don't win, you can still win their cash prize. Even if you don't want to get a job, you can still win their cash prizes. So there's a lot of if you're a US trader, there's a lot of good reasons to at least try, right? All right, so please join me for live trading on Wednesday. The Apex 80% off expires this week, according to them. And so we don't know if it's going to be extended, so make sure you definitely take advantage of that discount code. And if you have any questions, definitely check me, contact me over X, and then if BK traders, we'll keep going as the week progresses, and hopefully we'll get some good opportunities. Otherwise, have a great trading week, and I will see you on Wednesday for live trading the U.S. inflation report. And I'll be live trading Forex, not the NASDAQ like Boris, and we'll see what kind of opportunities we get. All right, have a great trading week.